After putting in a multi-month high near 44 basis points on May 9th, the 2-year Treasury versus 10-year Treasury spread has begun to narrow again down to a current level of 29 basis points. Now this comes after the May 11th CPI release, which showed a very slight downtick from a 40-year inflation high and a 5-year break-even level that has accelerated a decline that began in late March from a high of 3.76 to a low of 2.87. Some analysts may argue that the flattening of the yield curve is suggesting that the current Fed hawkishness may be moving us ever closer to a recession, or more simply, that perhaps inflation will become less of an issue in the future if the Fed stays aggressive. Now, the retail sales numbers released on May 17th suggest that the consumer is still spending despite the historically high inflation, which caused the 2s versus 10s to steepen a hair that day. Now, if a trader believes that the curve may continue flattening, perhaps even invert, they could express that by buying the May micro 2-year Treasury yield futures contract at 2.74 and selling the May micro 10-year Treasury yield futures contract at 2.98. Now this is selling the spread at 0.24 or 24 basis points, and they could target the early April lows of negative 0.07. A stop for this trade could be set above recent highs at 0.48. This trade would make $310 if your target is reached and risks $240 if you're stopped out at your level. Now, if a trader believes that the curve could steepen from here, perhaps in response to a better than expected retail sales alleviating some of the recession concerns, they could express that by selling the May micro 2-year Treasury futures contract at 2.74 and buying the May micro 10-year Treasury futures contract at 2.98. This would be buying that same spread at 0.24. A trader could then target the February highs of 0.68 and set a stop below at negative 0.08. This trade could make $440 if your target is reached and risks $320 if you're stopped out of your level.